Well, good morning, everybody. I apologize for my tardiness here.
We have to elect you. Hold on.
Okay. So who calls the meeting to order? Okay, very good.
Good morning. Oops. Good morning. This is the Oklahoma City Employee Retirement System, April 11, 2024, 10 o'clock a.m. meeting, and I would like to call the meeting to order. And then our first business that we need to do is nominate a pro tem chair for the meeting.
Nominate Doug Dillon.
Okay, Doug has been nominated with a first and second, and on this one, I'm going to go ahead and take a roll call vote. Trustee Davis, and I'm sorry, Trustee Nichols, Trustee, I just went blank, Reese,
Yes.
Trustee Weller, and Trustee Thurman, and Trustee Janata. So Doug is now going to take over the meeting.
All right, and again, I apologize. I lost track of time in another meeting there, so I apologize for my delay. So our first order of business is to approve the minutes from the March 14th, 2024 meeting. You should have received those in your packet, and so I'll take a motion to approve those. It's been approved and seconded, so we'll vote. And that passed unanimously. All right, the next item of business is a presentation from our investment managers at Ernest Partners. So I don't know, Jason, if you want to kind of give a little intro.
Just as we did last month, we're just regular updates from managers, getting in the habit of having them come in. It's been a few years since we've had regular updates. Ernest Partners is a small cap value manager to complement Silvercrest on the growth side. You'll note from the ASAP, Ernest is, I think, your longest standing manager. You've had Ernest in the portfolio since 2003. One of the things we look for is consistency of people, process, and results, and they've been able to do that. Since inception, returns have been well ahead of the benchmark. I'm not going to go into details on their portfolio. Trey Greer, who's here, we'll talk about that, but I do want to mention, as we've communicated to you from time to time, we reach out to managers and make sure that we're getting the most favorable fees, that each client is getting the most favorable fees. When you initially invested with them in 2003, I think it was early on in the life cycle of this fund, and you got a very favorable fee schedule. In looking at that and talking to them this week, we felt that there was some ability to negotiate a little bit lower fee, and so they're willing to amend their fee schedule. Currently, it's 100 basis points on the first 10 million, and then 70 basis points thereafter. The thereafter is going to go down to 60 basis points, so that'll equate to about a $60,000 a year savings to the plan, and we'll work with them and staff to get that amendment together. So I wanted to mention that, steal the thunder from him, since we've both worked on that together. But Trey, I'll turn it over to you.
Great. All right, thank you, Jason. All right, well, it's good to be back. It's been probably 7 or 8 years since I've been out here, and for the last time, and then about 20 years since I first came out here. So as Jason said, we really enjoy getting in front of the long-term clients for a lot of different reasons. But again, my name's Trey Greer. I'm a partner at the firm. And it's always nice to get to Oklahoma City. My son just moved here 6 months ago. So anytime you need an update, I'm always looking for a reason to come to Oklahoma City now. But anyway, so let me just update you, and I don't want to take any more time that's needed. I'll kind of get through it fairly quickly, but always open to any questions that you have. Let me start with just a firm update. There's no changes to report in terms of the structure and the ownership of the firm or the process that we follow. So in terms of our ownership, since we started managing for you 21 years ago, we continue to be employee owned. early on, we would meet with people and they'd always say, yes, you are, until some big bank or brokerage company comes along and makes you an offer, and then you'll be in a subsidiary of some big organization. We've always said it just doesn't really fit us what we want to do. And so after 23 years, I think people are finally kind of taking us at our word that we really do think it's the best business model for us. So in a lot of different ways. One is we control our own resources. We don't have somebody telling us what we can spend every year on headcount or investment research or anything like that. Allows us to attract really good talent in terms of people that can pick securities, because it's always easier to attract somebody when they're an owner of the firm or can be an owner of the firm as opposed to just an employee. So that helps us. And then just the culture of the firm, just having people that feel like you're an owner every day versus just an employee. So that continues to be, and no changes to report there. In terms of the process, it's the same process that we followed. Obviously, technology gets a little bit better and how you execute it changes through the years, but the underlying three-step process that we followed for you for 20 years is still intact. So we have a screen that we have that allows us to narrow. So we manage a small to mid-cap value mandate for you, so there are roughly 2,500 names in the universe. So we have a screen that allows us to narrow that 2,500 names down to about 150 that we really then can sink our teeth into and understand at a really in-depth level. We are long-term investors, so we're not traders. A lot of times small cap managers will turn a portfolio over 100% a year, 70% a year. Our average holding period is about 5 or 6 years. And so, we really are investing in the company, not just trading it. And so we really want to be able to really analyze it in depth. So narrowing it down to 150 allows us to really get a good handle on the names that we ultimately choose for you, which is a portfolio of about 60 names. And then, as a part of that process too, risk management's very important. As Jason mentioned, we've been able to outperform really over all the periods. And one of the ways you outperform over a long period of time is not necessarily outperforming all the time, but just minimizing the underperformance. Sometimes if you don't dig a hole, that's your best friend. You don't necessarily have to shoot the lights out all the time, but if you don't dig a hole every couple of years, you can beat the benchmarks. And so that's what we've been able to do. And so our risk management is really focused on minimizing that risk of underperforming the benchmark. And so that process, again, has been in place since inception, and one that we continue to follow. If you're kind of going along in the book, I'm not going to hit all these pages, but I believe on page 3, just real quickly in terms of the markets, I'm pretty sure everybody in here probably follows it pretty closely. So I won't spend a lot of time here, but it's obviously been a good start to the year, been a good 12-month period. So small to mid caps up about 6 to 7% for the first quarter, and up about 22% over the past 12 months. So it's been a strong absolute period. Continues to trail large cap. Large cap is kind of the place everybody wants to be, large cap growth. So you hear a lot about the Magnificent Seven and all that, but small caps continue to trail a little bit by about 400 to 500 basis points a year for the last 2 or 3 years. But one of the things that may change fairly soon and kind of turn that around, other than valuations just on a standalone basis make a very compelling case for small caps. If you look at small cap right now, compared to large cap, it's trading at like a 30% discount on a valuation basis. And if you go back kind of 30 or 40 years, small cap typically trades at a premium to large cap, which you'd expect because small cap companies grow faster than large caps. You'd expect to pay more for $1 of earnings, but the last 4 or 5 years, it's actually been reversed. So from a valuation standpoint, small cap's well positioned, but also everybody's talking about interest rates nowadays, and it's looking, we had a inflation number that came out yesterday that showed that inflation was a little bit stickier than everybody thought. So we may not get interest rate cuts as quickly as everybody anticipated, but eventually they will come, and that's usually adds fuel to small cap. Small cap companies tend to benefit from rates or cuts in interest rates. And so if that happens, we'd expect small cap to do well in that environment. So again, absolute returns have been great, trailed large cap, but like everything else, those things come in waves and will certainly turn around at some point. And then everybody knows, AI is really driving a lot of the large cap returns and, a lot of the valuations that you see out there. People talk about the market being highly valued, and there certainly are some names that are out there. But in the small cap universe, there's still a lot of performing undervalued names. And so you hear a lot about, NVIDIAs and the super micros and all the names that are in AI chips and the valuations they're trading at. But you're still able to buy a lot of companies that are involved in that whole evolution, but just aren't trading at those super high valuations, and that's kind of what we're looking for.
On that,
Yeah.
we just touched on this before the meeting. not as relevant to the value side, but on the growth side, the super micro and
Yeah.
micro strategies.
Well, Jason, do you mind being up at the microphone just so, yeah, a little easier to hear?
Just wanted to follow up on that, just because of the challenges that active small cap, particularly on the growth side, have. And you heard this from Silvercrest last month, as a result of some of these AI names that make up 3 or 4% of the index now. We're up 250 to 300%, and now they're no longer small cap names. But they're in the index, so it's been a challenge to keep up if you don't own those names.
Yes, for sure. And the growth managers has been tougher because we don't, as a value manager, we're not typically investing those type names. But he talks about Supermicro. That was a company that was a $5 billion name a year ago, and it's almost $60 billion now, and it's still in the index. So it's a huge weighting. So it's sometimes your relative performance can be more who you don't own than what you do own. So like, why aren't your names performing? Well, they are performing. We just didn't own X, Y, and Z, and those are up 500%.
And you're not allowed to own.
And you're not allowed to own them, that's right, just from, from a guidelines perspective. So it's much more of a headwind for the growth guys, but certainly even on the value side, you do see a little bit of that. But AI, like everything else, it's going to make a big difference, but at some point, there's only so much you can pay for a company in it to be realistic. So, but there are a lot of small cap companies that will benefit from that. We kind of think about it in the picks and shovels approach from the gold rush. You don't necessarily need to find the gold, but if you're selling the picks and shovels for the people that are looking for the gold, you can make a lot of money. And so that's kind of the approach we have. Is there's a whole ecosystem out there of companies. You don't have to be NVIDIA, but there are a whole ecosystem of companies out there that will benefit and support NVIDIA and what they do and other companies, and that's what we're looking for. So with that, let me jump into the portfolio update. So on page 5, you can see the results over all the periods since inception. And so your portfolio is that top line, and then the benchmark, it says blended, but that's the benchmark, which is the Russell 2500 value, small cap value, or small to mid cap value benchmark. And you can see really over all periods, the portfolio has outperformed, most recently in the first quarter. But going back over 20 years, so since inception, the portfolio is up about a little over 12%. The benchmark's up about 9.5, just less than 10, so about 250 basis points of outperformance. And again, I like coming to seeing long-term clients for a lot of reasons, but one is you can kind of see how what you initially present, how it actually plays out. And you've certainly been patient with us. We've had some periods where we've underperformed. You want managers to underperform. If they always track the benchmark, you can get their services for a lot cheaper by just buying an index. So you want someone that looks to outperform, knowing that there are periods that you underperform, but over time that can wash out and you can outperform. And so over 20 years, we've been able to do that. And it's really been a proof statement as to what we present to our clients, which is we think we can generate about 10 to 12% annually of absolute returns and outperform the benchmark by 200 to 300 basis points. So when we go out and meet with new clients, that's what we say. That's what we've always said. Because small cap over time generates about 10 to 11%, and we think we can beat that by 200 to 300, and that's kind of what's happened for the last 21 years. So again, it's nice to come out to long-term clients and be able to look back on something and see how it's played out. One of the things I want to mention too, and I didn't mention earlier in terms of the team, and I know we've shared this with you before, but one of the ways we get, really the main way we get alpha, is the composition of the investment team. So a lot of investment managers, first off, we don't have a 1 PM. So a lot of managers will have 1 PM, and you have a lot of research analysts underneath that are walking around trying to give ideas to the PM, hoping that their idea will get heard and that idea will be bought in the portfolio. We don't take that approach. We have 10 people on the investment team, and all 10 people are responsible for researching names and then coming together as a group and deciding, hey, what are the 60 best names we can own in this portfolio? So it really is a team approach. And what we look for, I mentioned our ownership structures, we want to go out and find people that are practitioners. So I always say, it's great if you sat behind a Bloomberg machine for 25 years, but you really can't understand a company just sitting behind a computer screen. You have to be out there in industry and actually, operating a business to really understand what drives a company, beyond if you're just trading stocks. And so we look for practitioners, so people that have actually been in the industry that they cover, so people that have been in the technology industry for 10 or 15 years, or the healthcare industry. So for example, the most recent person we hired it's been about 2 years ago, has a PhD in microbiology, worked for the CDC for a number of years, and then a startup biotech company. And so we hired him. And so he's able to really understand a healthcare company much, much better than someone who just graduated from college and was given, a book and said, hey, study up on this industry. You're going to cover it from now on. So that's what we look for. So really, these results are a byproduct of not only the screen and the process that we follow up front, but it's really the makeup of the team that's able to go out there and really find companies and look at things that most analysts don't look at. When we meet with management teams at companies, one of the consistent comments we get is after the meeting is, you guys ask a lot different questions than most analysts do. Most analysts come in here and they ask us about our dividend policy, or they ask us about how much leverage we're going to have on the balance sheet, what's our earnings per share looking like for the next 3 or 4 years, and we're asking much more operational questions. Because again, we're going to hold those companies on average for 5, 6, 7 years, and so that's important to us. So I bring that up just because that's really what drives these returns over time, and that's the type of people that we're looking for at the firm. On the next page, page 6, we talk a lot about percentages in our business, but at the end of the day, you have benefits to pay, and so it's real dollars that matter. So we always like to put a chart in here that just shows, again, 21 years ago, the inception value of the account was $17 million. Over the years, it's gone up over $95 million during that time. So there's been about $42 million in withdrawals to pay benefits over that time or to reallocate, and that gives you the $70 million balance as of the end of the quarter. And as Jason mentioned, it started out at 14 million, so that second break point didn't have a lot of impact. Now it does, and so we're happy to kind of share that with you and help the plan save a few dollars here and there. So that's kind of where the portfolio is today. So again, about 70 million in the SMID value. The next page, page 7, just a couple more pages, then I'll wrap it up. Page 7, we are a bottom-up manager, so we're not going out there and trying to specifically identify certain sectors or certain attributes. But here you can see on page 7 and 8 just both the sectors and kind of the statistical profile of the portfolio. On page 7, you can see on a price-to-earnings basis, again, very reasonable. We're paying just under 15 times earnings, which is in line with the benchmark. So certainly lower than what you would see, say, in large-cap growth. Return on equity is just simply how are these companies using the capital that you provide them for their business. And so you can see the benchmark is in the light blue and your portfolio is in dark blue. The companies that we're buying have a higher return on equity. And then the last one is just the leverage that they have. A lot of times companies will juice their return on equity by having a lot of debt. You take on a lot of debt, you can get high returns if things are good, and you can lose a lot of money if things go bad. But these companies that we buy aren't just simply taking on a lot of leverage to get high earnings. They're actually very reasonably financed on their balance sheet in order to get the earnings that they get. So those are just a little statistical profile of a couple. We tend to buy very high quality companies, so we like to show that just to demonstrate what that is. And then the last page, on page 8, is, again, we are a bottom-up manager, so we're not out there looking for overweights or underweights in certain sectors. We don't sit around a table and say, we think we should be overweight technology, or we think interest rates are going to fall next quarter, so let's be overweight, cyclicals, or whatever the case may be. We're just trying to find good companies that can outperform over a market cycle. But it is interesting at times just to see where we're finding, opportunities at any point in time. And so you can see on page 8, a couple of the areas where we found more relative opportunities are technology and energy. And then areas where we found less is healthcare and utilities. And a lot of healthcare in small to mid-cap is biotech, and biotech's a hard company to analyze because it's really either you win a lot or you lose everything type proposition, and not something that we feel like you can consistently kind of predict on a day-by-day basis. So we tend to be a little bit underweight, kind of the startup biotech type company, and so that's kind of consistent with what you see, historically with us. And then technology, we do have an overweight, but if you look at the companies we own, again, they're not the names you hear about on CNBC, but again, they're the companies just supporting the infrastructure for a lot of the technology that's just making businesses and governments more efficient every day. Productivity is something that had really dropped the last 3 or 4 years, and we're starting to see it bounce back. And so technology is a big part of that, and so companies that are participating in that. So with that, I've talked a lot, so I'm going to kind of wrap it up. I'm happy to take any questions about anything in the portfolio, the firm, or whatever.
Questions from board members? I'd be curious, you said about 5 or 6 years is the holding period for most of your
Yes.
holdings. What's the normal reason that something drops out of your portfolio?
A couple reasons. One is, the best reason is it no longer is small and mid cap. That's the
Yeah,
grade. It
right,
graduates
right.
to high school.
Yeah.
It goes to large cap. So, that often is the case.
Mm-hmm.
We won't sell a name overnight just because it gets to,
I didn't know if you
it
have
was
like a-
super
if you-
micro, we'd sell it for sure. It's 50 billion, but
Yeah.
but if a name gets above 20, 25 billion, we'll sell it.
Mm-hmm.
In short, so that's a reason. Two, the proposition plays out. We identify something early on. We say, hey, this is what we think the market misses. The market eventually, as I like to say, gets the joke. They realize it, and you cash out. And then also, you own 50. I always tell people, if you own 60 names and 20 of them underperform, you're top quartile. If you get 2/3 of the names right, you're doing really well.
Yeah.
And so, there are always names that just don't do what you expect them to do. And, I say the average holding period is 5 or 6 years, but there are names that we pull the plug on in 6 months. They're just not doing what they need to be. So that's the average. At the same time, there are a few names we've owned for 20 years for you. So, there are certainly some outliers on the end, but, typically it's 5 or 6 years. Yeah.
Other questions? Yeah? All right. Well, Trey, thank you, and thank you. Welcome back
Okay.
to Oklahoma City. Glad my son's moving back to Oklahoma City too, so
Is he?
I'm very
That's
excited
great.
for that too.
That's
so.
great. I may have to move out here now that he's out here.
Yes.
That's wonderful. So anyway, I appreciate it.
Thank you very much. All right, we don't have to have a motion or anything, we just accept the presentation. So our next item on the agenda is the consent docket. We've got 4 items there that can be taken with one motion. If someone would like to make that motion and second. We've got a motion and a second, and so now, let's see, I think we got to switch back here. There we go. On the presentation as opposed to computer? Yep. There we go. All right, and that passes. All right, so the next item is to ratify various approvals. I believe do we need to vote on these each individually, correct? Or no, we can vote on that. So we have payroll claims. I don't know, I think on item D, I think Regina had talked about this, where we had some places where the pension was calculated incorrectly for, I don't know what we have here, about 20-some people, 16. And so this is a correction to their distributions. I do have one question, Gina. I don't know if you would have the answer, and maybe we can get that later. Will we be going back to make up the contributions back to when they originally retired, or is this just effective as of this meeting?
We are going back retro
Okay.
to when they retire and
Very good.
calculating forward. so.
Okay, I appreciate that clarification. I just wanted to make sure of that, so thanks. All right, so we've got 4 items on the, to ratify. Are there any questions before we move on then? All right, then we will take a motion in a second. It's there. Please vote. All right, and that passes. The next is the claims docket, and I believe the list was attached for your approval there to review, and so we'll take a motion and a second for the claims docket. And vote there. All right, and that passes. All right. And then our next item is to approve the following applications for service retirement. And we've got 5 on there, so I'll take a motion on that. And that passes. Our next item is to receive report of death and authorize the payment of death benefit and authorize the secretary to make necessary changes for these individuals. If you'll got a motion and a second, please vote. And that passes. All right, so our items for individual consideration. The first item is to approve purchase of desktop scanners and personal shredders for ERS staff for $2,600. I think the memo kind of explained the rationale there of trying to become more electronic in their documents rather than lots of paper. Any questions there for staff? All right, we'll take a motion and please vote. That is passed, that is approved. Item B is to approve sending Richard Mahoney and Brett Logan to the National Association of Public Pension Attorneys Conference in June, and so I'll take a motion on that. That's moved and seconded. Please vote. And that is approved. Item C is to approve the retention agreement with the securities law firm of Leviton, Keller, and Sukarau to represent OSERS in prosecuting a securities class action to recover losses sustained by System and other class members as a result of investments in Shoals Technologies Group. And additional information there. So any questions there? Or if not, then we'll accept a motion to proceed with that. All right, that is approved and seconded. Please vote. And that is approved. And then the last item here is to receive the investment consultant report, the monthly investment report. So I don't know, Jason, if that's you or? Yeah. Okay, either way, okay.
I have some comments.
Yeah.
Just going to tag on to Trey's comments since he's still here. This slide where they showed the initial investment and the return on investment. It's one of the best slides. I always look at manager presentations and say that's a great slide, and they've always done some form of that. But just to put that into further perspective, that $42 million that comes out, I think we lose track of that. When we're doing rebalancing and you have asset allocation and targets and we rebalance from what's done well, generally to pay benefits, you need cash every month, every quarter, about $4 million. So we're taking from what's done better to fund that. Sometimes if things get a little out of whack or we make asset allocation changes, which we've done now, you do have to move from one asset class to another. But just in perspective, that $42 million, that's about 2.5 years worth of benefit payments that has been funded from this one portfolio that's about 5% of your total fund. So done a good job over that 21-year period. I'm going to go through the ASAP report, and then we have another rolling return report that we just handed out that we'll touch on. In terms of markets really continue to trade on similar themes, as you heard from Trey. Interest rates from day to day, the direction of rates or concerns are whatever inflation numbers have been reported really impact the markets in the short term. We saw a CPI number yesterday that was a little higher than expected, and so interest rates went up. The 10-year moved up to 4.55. The 10-year is up about 65 basis points year to date. So bonds are down year to date. And on days like that, we see equities sell off. The S&P was down about 1%. This morning, the PPI came in a little bit, I guess, lower than expected, but still higher than last year. And so we'll see what that does today. The bottom line is it's not looking like there's going to be multiple rate cuts this year, certainly not the 6 that was believed in the middle part of last year, as we're already here in April. And we're starting to see a little bit of a sell-off and perhaps some of the exuberance as we've hit multiple all-time highs in equity markets this year. As we look at your portfolio, and I'll let Patty touch on this, we did make some strategic changes to your asset allocation targets at the January meeting. So it's reflected in the target allocation, but we haven't made any, done any rebalancing short of cash needs, and we'll talk about that.
Yeah, so as you might recall, we revisited the asset allocation at the January meeting. You all approved those in the investment policy statement in the February meeting. And then when you look at this March report on this page, you'll see the new asset class targets for each of the specific asset classes. And one of the primary changes was the target to overall equities. So equities, the target to equities was 65%, and that was reduced to 60%. And then there were some subsequent changes to the underlying sub-asset classes. So large cap was decreased from 18 to 15. International equity was increased from 11 to 15. In emerging markets, there's a slight change, 6 to 5. The big change was in long-short equity. So that allocation, previously you had a 5% target there, and that has been reduced to 0. So the redemption notifications for the underlying strategies was submitted. That will be effective June 30th, and then it will take about 4 quarters to receive the proceeds. There'll be a fairly significant distribution that will come back in July, and then there'll be subsequent distributions for 4 quarters following that. So as we receive those distributions, we'll reallocate those to the underweight asset classes at that time. So right now, when you look at this page, you'll see, the equity allocation is currently at 68.7%. It's overweight the new 60% target, but it's within that range of 50 to 70%. And then, as I mentioned, as we get these distributions, we'll use that as the opportunity to rebalance to those targets.
And it's the lowest risk, the lowest vol strategy within equities, and that's going to be, as Patty said, when that money comes back from the long-short equity managers, number one will be cash needs, and then second, we'll go into fixed income. So I anticipate we'll be increasing your fixed income allocation pretty significantly with those allocations.
Yeah, the fixed income was at 20% and went to 25%. So essentially took that money from long-short equity and reallocated it to fixed income.
And we'll also be looking at some, within asset classes, some potential rebalancing. Within small cap value is overweight small cap growth, just because value has done so much better than growth. And so we'll probably make some modifications there as well.
And then one other thing to note too is private equity. So you have a target allocation of 15% to private equity. Currently, you're about 8.5%. But private equity is very different than your other traditional asset classes, where you make a commitment, those dollars are called over time, and then proceeds are distributed as the investments are realized. And so it works a little bit differently. So essentially, the dollars not currently invested in private equity today are invested across your, traditional equity asset classes, large cap, small cap, and non-US.
So as we move to performance on the next page, while we changed the target allocations, we have not modified the policy index yet. So the policy index will be modified to reflect those changes. So meaning the S&P 500 or equity will come down because, as you recall, currently the S&P 500 is 35%. It represents your large cap, long short, and private equity. The dispersion of the total portfolio relative to the policy index is mostly coming from long short and private equity. Doesn't look anything like the best performing asset class of the last year, which is large cap US stocks. That 5% is going to go to the aggregate bond index in the policy index. And so that's going to change on a go-forward basis. It's not retroactive. But I mention that because over the last 2 months, or since these decisions have been made, while we're trailing that policy index that is heavy in the S&P 500, what's actually happened, long-short equity year-to-date is up 4.7%, and bonds or fixed income is down 1.1%. So we're actually, the timing of getting the money to work in fixed income isn't hurting us. We're doing okay, and most of that money is fairly conservatively allocated. So overall, on a trailing one-year basis, we're up about 11.6%. Trailing the policy index, it's the things we've mentioned, primarily private equity and long short. You'll note private equity is up 5.8%, whereas the S&P 500 is up almost 30%, 29.8%, and that's what we're comparing to in the policy benchmark. From a manager standpoint, and we've touched on your two small cap managers the last two months. As I alluded to, small cap has been pretty challenging for active managers, particularly on the growth side. A couple of names, and we mentioned them, Trey mentioned them, Super Micro and Micro Strategies. 50% of the return of the Russell 2000 growth was from those two stocks. So if you didn't own those two stocks, you weren't keeping up with the index. And most active managers, including your manager, Silvercrest, doesn't own those stocks. And for multiple, if they didn't own them at the beginning of the year when they were small cap stocks, they're not going to buy them when they're now 50 billion market cap stocks. And so that's a pretty big challenge for small cap managers. So that dispersion on a one-year basis for your overall small cap, mostly it's really all coming from the growth side. Still good absolute returns, but it's been a challenge to keep up with the benchmark there. On a bright note, I'd say, your real estate, while down, your real estate overall down 4% on a one-year basis. The Morgan Stanley Prime Fund, heavy allocations to industrial and multifamily relative to peers and other Odyssey or open-end domestic core real estate funds. A lot lower weighting to office, which has helped dramatically. So while they're still down about half as much as the benchmark. We also have quite a bit of unfunded commitments in the non-core real estate. We made commitments of $10 million to Blackstone in March of last year, $10 million to Angelo Gordon in October of 2022, and $15 million to Starwood in January of 2022. So that's a total of $35 million, of which there's still about $25 million in remaining commitments. I mean, they haven't called or put that money to work, which we think is attractive. They're going to be able to put money to work in an environment where there's a lot of distressed properties or distressed property owners out there that are going to have to, at some point, sell what are good properties, but they're just not able to meet their capital structure currently, and it'll be a good entry point going forward. So with that, next month we'll have the quarter report, and we do have a private equity recommendation next month that we'll be bringing. We don't have any managers until the June meeting, and I think we'll have the fixed income managers at that time.
All right, any questions?
Yeah, I have one. And I probably missed this, so I apologize for it. But what about an international developed market that's underweight from the ranges we have?
Right. So that was increased.
From 11
That
to
was
15.
one of the areas that was increased. So as money starts coming back, we'll be using that as well to rebalance into there. So that was at 11, and that was moved within equities. Although equities came down by 5, international went up, large cap came down. So when this money starts coming back, we'll do rebalancing among everything.
Okay, thank you.
And kind of along those lines, I mean, we're pretty far overweight of the target for a large cap equity. I assume though that that's going to be a gradual process to bring that down. Kind of what would you think that over the next year, 2 years, that'll change, or?
I think we'll start to see some of that change even over the next 6 months.
Okay.
Yeah. And we're going to have, because the private equity is 7% underweight and we can't get to that target,
Yeah, if
it's
people aren't-
intended to have an overweight in U.S. equities for the unfunded
Okay.
portion of the private equity.
Okay. Yeah.
But I don't know if that question was coming because of where valuations are today. We are looking at Large cap has been and will continue to
Yes.
be the primary
Right.
source for your cash needs on
Okay.
a month-to-month basis.
Yeah,
And the cash needs will be for, benefit payments as well as capital call notices for the private equity allocation.
okay, yeah. Yeah. All right. Any other questions here from board members? All right. And thank you all. Yep. All right, any comments from board, staff, or citizens? Oh, yep. Oh, we need to receive, okay, so if we will vote to receive the report. So we need a motion and a second, and now we'll vote. And that is received. Yeah. All right, very good, we have no comments, and so we are adjourned. Thank you all very much.